Hey everybody, it's Matt from Interactive Accountants, and today on your CTO program, we're talking about tax deductions that individuals or businesses earning more than $500,000 a year can take advantage of. The first one I want to mention works well for individuals and business owners. It's a charitable investment fund. How does a charitable investment fund work, Matt? Well, it works very similar to the way that people donate appreciated property. Perhaps you've heard of a millionaire donating a Monet to a museum that they've owned for 10 years. Well, usually, not always, but usually, there's a tax play behind that. Maybe they bought that Monet 5 years ago or 10 years ago for, $10 million. And today it's worth $20 million. Since they held that painting for more than a year, the IRS allows them a step up in basis on that appreciated property when it's made to a charitable donation. So they're going to get a $25 million donation when they really only paid $10 million, let's say 10 years. And that's the same way a charitable investment fund works. It's just that you or I are stepping into that fund. We didn't have to go through the arduous task of holding on to something for more than a year. The next one we're going to talk about is restricted property trusts. These are kind of like a 401k, but instead of funded with investments, it's funded with a whole life insurance plan and some cash. The nice thing about them is that they're not subject to ERISA, which means you can discriminate who in your company gets one. Now, there are some caveats to a restricted property trust. Number one, it's usually a minimum 5-year investment. Number two, the minimum investment for each of those 5 years is $50,000. But it allows you as an individual, a business owner, this doesn't work for W-2 people. It allows you to take a tax deduction today for the funds that are transferred into the trust. The trust is then going to purchase whole life insurance. You're the beneficiary of that. And whatever it doesn't use for that policy, it's going to sit in cash, right? At the end of the trust term, whether that's 5 years or sometimes even 10, then the cash is going to come to you and the whole life insurance policy is going to come to you. Meanwhile, during those course of that 5 or 10 years, your business got a really nice tax deduction. And at the end of that period, the only thing you're really going to pay tax on is whatever cash built up inside the fund. So there is a little taxable event at the termination of the trust, but it's not bad considering all the deductions you got today. The third one we're going to talk about is investing in your business. Now, there's multiple ways to invest in your company. For myself, we invest in technology, we invest in software, we've already invested and are working with AI, and that stuff costed money. So we made those investments, and now we're getting either depreciation or amortization on that technology spend. But let's say you're a manufacturer. Well, maybe it's time for some new improved equipment. Or let's say you're a last mile logistics operator. Maybe it's time to purchase a couple of vans for your business because you're tired of renting from Enterprise. All those investments that we make in our business, they allow us to either depreciate them or amortize. Now, depreciation is usually where we're going to get the most bang for the buck because we can take advantage of Section 179, or if bonus depreciation comes back to 100%, which it's looking like it might, then we can take advantage of that bonus depreciation. And I like the bonus depreciation myself. So that's kind of like Matt, I've heard of 179 and all those sorts of things before. I get it, but it still works. And as business owners, we need to invest in our company to keep things moving along. If we keep doing things the same way we did 30 years ago, competition, technology, it'll wipe us out, right? If I was still doing bookkeeping on a ledger, I'd be out of business. So another one that we're going to speak about here is something that maybe you've never heard of before. It's fairly new. And these are sovereign tribal tax credits. These are tax credits that the government gave to sovereign tribes, right? And the sovereign tribes, they just didn't need all of them. So they decided that they're going to sell some of these credits to the public, like you and I. Well, what does that mean, Matt? Well, they're actually selling some of these credits at a discount. So that means I can actually purchase federal tax payments for 70 cents on the dollar. This works really well for individuals that want to show a high level of income because perhaps they're thinking about making an investment or needing borrowing at some point in the future, right? Let's say I want to buy a house next year. Well, I've got to show 2 years of high income to do that, right? Because I want to buy a $2 million home. Okay, but I also want to pay as least in tax as I can. So sovereign tax credits will allow you to take a discount on the amount of tax that you're actually paying, right? So they work really well in those scenarios. Another tax deduction that we like to implement with people is investing in real estate for your business, or just investing in real estate in general. Now, there are a lot of rules with investing in real estate. If you're not spending 720 hours a year, it could be a passive activity. But if you're investing in real estate for your business, then you're active in your business. So that real estate automatically becomes an active activity, and it's no longer subject to passive activity rules. So investing in real estate for your business is a great way to get a tax deduction because that building is going to depreciate. And then if you take advantage of a cost segregation study, which kind of blows our business up our building into like parts. So doors, HVAC systems, electrical systems, all those systems have shorter depreciation lives than the sticks and bricks of the building itself, right? The sticks and bricks, the foundation, that's going to be 39 years in a commercial setting. But the HVAC system might be 7 years. The electrical system might be 7 years. The doors, the panels, all the improvements to the building could be 15 years. So by taking advantage of that cost segregation study, we're still going to get the same depreciation, right? Because what we paid for the building didn't change, but we're going to be able to depreciate that much faster. And that's what a cost segregation study is. These are just a few of the tax deductions that we work with our clients on implementing once they're enrolled in the Your CTO program. If you'd like to learn more about the Your CTO program, please feel free to reach out to yours truly. I'd love to have a conversation with you about how we can help. Take care, everyone.